Welcome to Accounting 101. We are still under the topic of basic accounting concepts. So on this activity, we will be matching column A versus column B. With column A, we are referring to these particular accounting terms. If I could mention just a few, it's fixed or tangible assets, current assets, non-current assets, current liabilities, income, expense, and owner's equity. So we are going to match these accounting terms with their correct explanations. So let us begin. The instruction is clear. Choose a definition from column B that matches the type of account in column A. So column A, you have type of account. Column B, you have definitions. Let us begin. Number one, fixed tangible assets. So for us to be able to answer this particular question, it is more easy if we read the instructions carefully, because these particular instructions are telling us, or they are giving us guidance with regards to us reading column B, these definitions, and matching them with column A, which are accounting concepts or types of accounts. So let us look at column B. The first definition says A, this increases profit. So it has positive effects towards your profit and therefore increases owner's equity. If they say therefore increases owner's equity, it means that it has positive effects towards your profit. So it's an increase in profit, and that increase in profit will result in more amount of money that the owners are able to distribute amongst themselves in the form of dividends. So if we look at this type of accounts, we are looking at a type of account that will increase profit, that will also increase owner's equity. So the correct or the precise accounting term or type of account is an income, because whenever we receive an amount of money, the profit increases, your asset increases, your bank account, that is why I'm saying assets, then your profit also increases. It means that if you are having more incomes, your assets increases, your profit increases, then the owner's equity will also increase, or the shareholder's interest will also increase. So A will be matched with 5. Then, the second definition. This decreases profit and therefore decreases owner's equity. So, the clue here is that A, or rather B, is an opposite of A. So, in this case, we need to understand, or we need to try and figure it out with regards to which account type or type of account that reduces your owner's equity, that reduces your profits. One of the things that reduces your profit is an outflow of cash. If you are making a payment, and if you are making a payment, your profit is being reduced because less amount is being held or maintained within the company because of the payment, or it's reduced. So let us look at column A. The most accurate answer here is number 6, an expense. An expense is an outflow of amount of money where we are paying for our expenses as and when they fall due. And for such payment, it will increase the profit, and it will decrease profit, and therefore decrease also owner's equity. So it reduces or diminishes your expense, automatically it will also reduces owner's equity, because the income that is distributable to the shareholders will be reduced because it's an expense. So B is matched with 6b. Let us continue. So we have covered A and B. Now let us go to column B and try to answer or match number C or article C. Amounts owing that will take longer than 12 months. So we are not making a payment here, but we are looking at an obligation. We are looking at a present obligation. By present obligation, I'm referring to a situation where, as a company, currently we are aware that we are owing a particular creditor. That is the first clue, amount owing. Then the second clue is that will take longer than 12 months, meaning this particular amount owing, this particular present obligation, it's beyond the financial year, it's beyond the accounting period. Therefore, amount owing, you are referring to a liability. But if this particular liability will be settled or rather paid in full within the period for a period that is within 12 months, it means that that particular liability is a non-current liability because we have an intention to settle or to pay it in fully for many more years to come. Therefore, our intention of settling this particular liability or amount owing is not limited to 1 year, but it's beyond or longer than 12 months. So if we look at column A, we are going to match C with number 3. So it's a non-current liabilities. So let us continue. D, assets. So by telling us assets, it means that it's between the current assets or a non-current assets. So the first term asset gave us or is giving us a clue to limit our answer into number 1 or number 2. So it's either fixed assets or current assets. But let us continue. Assets which are expected to be kept for a longer period of time, usually longer than a year. Without them, the business will not exist or earn profits. Okay, let us break this definition into manageable parts or segments. First one, assets. So we're now looking at fixed assets or current assets. Okay, that one is sorted. Which are expected to be kept. Now, if they're saying which are expected to be kept, the question is that for how long? Because that is so important in such a way that we'll be able to match it with fixed assets or current assets based on how long are we planning to keep this asset. Usually longer than a year. So longer than a year, it's non-current because it's beyond an accounting period, which means the intention that we have, or we bought these particular assets for the not for the resale purposes, but to keep and use. So our intention is of long-term view. Without them, the business will not exist, meaning that we are also keeping these assets with the intention that we're going to use these assets for them to be able to generate income or to generate what we call an economic benefit for us as a business. So we're going to link D with fixed assets. You can call it fixed or non-current assets. By tangible assets, we are referring to asset that has what we call physical existence, that we can feel, that we can touch. So D will be matched with 1. Then let us look at E. The value in brackets net worth of the business at any point of time. They are giving us a clue where they say total assets less total liabilities. And if you fully or thoroughly understand your accounting equation, you'll be able to understand that your assets, or you'll be able to recall that your assets are equal to your owner's equity plus liabilities. Therefore, if you say assets minus liabilities, you're going to get your owner's equity. So here they are looking at the net worth. How do you get, or how do you calculate your net worth? You say your total assets, both current and non-current, minus your total liabilities. Then you get your equity part. Get your share capital, you get your retained earnings, you get your reserves. So we are going to match E with the owner's equity. So E will be matched with number 7. Then let us look at definition F. Amounts owing that will be paid back within 12 months. Amounts owing. They are not referring to an expense, but they are referring to a current obligation that must be settled within the financial year. So do not confuse an expense and a liability. Those are two different account types. So in this case, they are looking at a present obligation, they are looking at a liability. But this form of the, or rather this kind of a liability, will be settled within the current financial year. It means that we as a company have planned or made some kind of arrangements where we say this particular liabilities, or this particular amount that we owe, we are going to pay it in full within this particular financial year. So it's of a short-term intention, and therefore we're going to link or match F with your current liabilities, because they will be, it's an amount owing, it's a present obligation that will be paid within 12 months, within the financial year, within the current financial year. Then lastly, let us look at G. Assets which are expected to be converted into cash in a short period of time. Okay, the first clue, assets. So already our answer, or rather, yes, the scope of this question is limited to 1, column A, number 1, fixed assets, and number 2, current assets. But we are fully aware that we have matched long time ago your fixed assets. Then we assume here that it's number 2, your current assets, but let us confirm assets which are expected to be converted. So let us continue reading this definition so that we can understand the context of this term converted. What exactly do they mean by this particular conversion? So these assets are expected to be converted into cash. If they are expected to be converted into cash, one can think of a perfect example of an inventory being an item and being sold, being converted into cash in a short period of time. So the intention or the purpose is solely to make sure that these particular assets are bought or manufactured or produced with an intention of selling them within the short period of time. So the intention is to convert or transform these particular assets into cash. Therefore, it will be a current asset. Then this is the end of this activity where we were matching definitions versus your account type or type of accounts. Don't forget to like, subscribe, comment, and watch. Don't forget also to watch the upcoming videos that I will load or that I will upload, so that we go step by step when with regards to accounting for grade 12. So thank you so much for your support. God bless you.